In accounting, most people get confused because they learned debit and credit like school rules. Debit what comes in, credit what goes out. But in real life, that's not how businesses actually think. So today, let's understand the real logic behind debit versus credit in the simplest practical way. Meaning. The word debit comes from the Latin word debitum, meaning due for that. So debit simply means the receiving side of a transaction. The word credit comes from creder, meaning due to that. So credit means the giving side of a transaction. Core idea. Debit and credit do not mean increase or decrease by themselves. They only tell us which side of the accounting equation is affected. Every transaction has two sides. One account receives value. One account gives value. So remember, debit equals to value comes into the business. Credit equals to value goes out of the business or the business owes value. Think of them as labels, not maths. Business perspective. In accounting, the business is treated as a separate person. So whatever the business receives is a debit. Whatever the business gives or owes is a credit. This logic applies to all accounts, assets, expenses, income, capital, and liabilities. Assets and expenses, why they are debited? Assets and expenses are debited because the business is getting value. Examples. When buying a computer, the business receives an asset. So debited. While paying salary, business receives service for which it pays. So debited. Simple rule. If the business gets benefit, then debit it. Drawings, why it is also debited? Drawings means the owner takes money or goods for personal use. From the business point of view, value is leaving the business. It is not a business expense. It reduces the owner's capital. So the entry is drawings account debit. Cash or goods credit, asset goes out. In simple words, drawings means withdraw of value by owner. Liabilities, capital and income, why they are credited? These are credited because they represent what the business owes. Examples. When the owner brings money into the business owes it to owner. Hence capital account is credited. When business earned income, the owner's claim for it is also increases. Hence income account is credited. When business takes loan, it owes that amount to the bank, hence liability account is credited. Simple rule. If the business owes value, it should be credited. The real logic behind every entry. Forget complicated rules. Just ask one question. Is the business receiving value or giving value? If it receives, then debit it. If it gives, then credit it. This alone clears most confusion. Why school definitions confuse debit and credit? School definitions confuse debit and credit because they give separate rules for different account types, making students memorize disconnected phrases like debit the receiver, debit what comes in, or debit all expenses and losses. These rules break down for income, capital, and liabilities, and they hide the real logic. In actual accounting, everything follows one simple principle. From the business's perspective, value received is a debit and value given or owed is a credit. This single idea works for all accounts, assets, expenses, income, capital, and liabilities without needing any special rules. The real-life shortcut. You don't need long rules. Just remember. An account is debited, then business receives value. An account is credited, then business gives value or owes value. That's all. Conclusion. Debit and credit are not difficult at all. They simply track value flowing in and out of a business. Once you understand the real logic and their meaning, accounting becomes simple and practical. It's about understanding, not memorizing.